Swing trading can be a great way to profit from the market upswings and downswings, but as I've already said, it's not easy. Mastering swing trading techniques takes considerable time and effort. To help get you started, here are 25 rules to think about in order to master the swing trading game. These rules were developed by the money maker and author, the master of the swing trader books. Rule number one: if you have to search for the trade, it isn't there. The great trades are obviously if you analyze a chart and you don't see the trade scenario and you don't know if this is the long play or a short opportunity, you better change your chart and look elsewhere. Also, the best trades could jump out of the now here and create a sense of the urgency or and you must learn to act quickly before the opportunity disappears. Rule number two: trades depends on their time frame. When it comes to the market traders, it is all relative. For example, you could look on the monthly price chart and see if the trade is currently bullish. Yet, if you look at the daily chart, it could be a very strong bear trend. At any given time, the trend will be both bullish and bearish depending on the time frame. Being monitored, make sure your trade first fits the clock's price movements. Alright, specific time cycles. Success depends on the trading, the right ones. Rule number three: price has memory. The market remembers things that happened a long time ago and then suddenly permits those things to have the influence once again. That's why you need to have full analysis of the any chart, what happened the last time stock trade to certain level, chances are will happen again, which the type of the closer when the price results to the past battleground. The prior actions can predict the future. Rule number four: profit and discomfort start suddenly by side. In the trading or investing, you might find the setup that scares you the most because that's the one you need to trade. Don't expect to feel good until you take your profit. If it did, everyone else would be trading it. In ancient quotes says what was that was at first brings bliss. In the end, give only pain. But what at first causes pain ends up and great pressure. So you need to learn to handle trading pressures and deal with emotions. Rule number five: buy the first pullback from the new high. Sell the first pullback from the new low. Trends often test the low support resistance before taking off. Trade with the crowd that missed both the first time around. Breaks out often return to the cross stance levels, testing new support or resistance after the initial trend wave. Pullback positions take close to the price levels show excellent reward to the risk profit that supports a wide variety of the swing trading strategies. Number six: buy at support, sell at resistance. And this is obvious. The trend has only two choices upon the reaching the barrier: continue forward or reverse. Get it right and straight could become the simple process. Rule number seven: don't trust opinions of the other. It's your money and take not theirs. We see a lot of examples of the hurt mentally in investing and the financial decisions due to the fact that many people don't really understand what they are doing when it comes to the market. Do your own analysis regardless of the information source. Manage time's efficiency as price. Time is money. In the markets, you must estimate your holding period for the every trade. In order to manage time effectively, you must gather and analyze data. Doing this makes you continuously aware of what is going on in the market. It lets you plan and make well-informed decisions about the trading goals you set and how you achieve them. Rule number 9. Avoid the open. The first 15 minutes of the trading sessions stands out from the rest because the unique market machines that surround it, overnight news flow often creates a demand for buy and sell orders, which gets submitted pre-mark ready for to be expected as soon as the bells rings, often making the trading during the time chaotic. This rush to exclude often creates the exchanging movements to the gates, many of which may not hold and could possibly retrace late in a day. If you want to become the conservative, avoid the open. Rule number 10. Be aware of the market's trends only 15% to 20% of the time. Markets don't trend that often. Then actual trend lasts only a short time, approximately 20% of the trading period, and during the remaining time, price remains in the consolidations or pattern formation. So be prepared for choppers on the dead periods where the price may be stuck in the range. Rule number 11. The best traders show major confluence. Confluence occurs when the several teaching indicators or tools give the same trade signal. Confluence of the trade signals could lead to the greater accuracy. For instance, this happens when the support and the resistance level are closely in the line with Fibonacci retracements and the extensions level. Physiological levels, previous highs and lows, and dynamic supports and the resistance level, such as movement average or the Bollinger Bands, can also attract the area of the interest. When these levels coincides, they from the strongest supports or resistance level, which could be used to the entry points or taking profit levels. Rule number 12. Don't confuse exclusions with opportunity. It's impossible to make money trading or investing in your have good strategy, but it's poorly exclusive. Emotions and the flat fingers don't make successful trading careers. You must understanding price behavior and market mechanics. Learn what a good trade looks like before the entering positions. Rule number 13. Control risk before the seeking reward. Attention to the profit is the sign of the immaturity, while attention to the loss is the sign of the experience. Certainly, many investors might end up losing a lot of the money. There are many reasons for this, but one of those comes from the inability of the manage risks. Stop thinking about the gains and focus on the controlling the risks. Rule number 14. Big losses rarely comes without warning. When you suffer a big losses, you have no one to the blame but yourself. The chart told you to exit the positions, the news told you to leave the market, and maybe even you got God told you you are wrong. With time, you need to learn to visualize trouble and hurt the safety with only a few bars of information. Rule number 15. Bulls lives about 200 days moving average while the bears live below it. The 200-day moving average divides into investing world into two. Bulls and greed lives above 200-day, while the bears and fears live below. Sellers eat up the rise below this line while buyers come to the resource above it. Rule number 16. Entered in the mid times, exit into wide times. The big movement hides just beyond the extent of the trading range. Don't count on the agitated crowd for your entry signals. It's usually too late to act by the time they enter the market. Entering a position in mild times. As volatility is expanding, increasing the odds of the good trades. Extending quarter student stops in wild times helps preserve profits. Rule number 17. Perfect patterns carry the greatest risk for failure. The truth is that the precise patterns set up the most painful losses. If it looks good to be true, it probably is. Number 18. Tends rarely turn to the mine reserve to build slowly. Investors are very stubborn and usually take a lot of the pain before they admit defeat. Rule number 19. See the exit door before taking the trade. Here's the useful mind test to help me a lot. Assume the market will reserve in the minute you get failed. Always have the stop loss in the place because it case made the world of the difference. Rule number 20. Profits aren't broken until the trade is closed. The market gives and takes away profits with great fury. You shouldn't assume that something will definitely happen before it really does. Don't make the plans based on the prediction result that haven't occurred yet. Don't have the playback mentally. You don't deserve anything for all your hard work. The market only pays off when you are right and when your teammate is really good. So focus on the being right and not on the making money. Don't try to get even. The trading is never a game of the catch up. Every position must stand and there. Take your loss with the composers and take the next trade with the absolute described line. Leverage trading is simple gambling driven by the fear of the furnace, and it can be devastating consequences. Number 23. Don't stick to the holy grail. There's the secret trading formula other than the good strategy combined with the solid risk management, so stop looking for it. Rule number 4. Don't forget to the discipline. Learning the basics is early. Most traders fail due to the lack of the discipline, not the lack of the knowledge. Discipline management is one of the hardest thing you are mastered. At the same time, it is the most important element of successful trading. It is up to your establishment pre-market routine and build strong trading habits. Rule 25. Don't think trading is the entertainment. Successful trading will be the boring most of the time, as successful traders know how to get into the trade and how to manage it or how to exit it. He is just exclusive. It's the same routine every day. Most of the time, it's even worse that there's nothing to do. It's just about sitting here and waiting for the something to happen and trade of the unfold. As always, if you learned something new and found valuable, leave us a like to show your support, subscribe to our channel and hit the bell icon to stay notified when we upload the next video. Until next time.